Florida's condo dream is shattering, not cooling, collapsing. Prices are not down 5% or 10%, they are plunging by 25%, 30%, even 32% in cities deemed invincible just 2 years ago. Families who secured units at the market peak are now irrevocably trapped underwater, witnessing their savings vanish. Retirees face devastating costs, skyrocketing insurance premiums, 4- and 5-figure special assessments, and a brutal economic reality. Buyers have vanished. Inventory is swamping the market. HOA fees are surging out of control, and the expense of keeping a roof overhead is now record-breaking. The former Florida dream has become a financial cataclysm. This is Discover the Nation, and today we reveal the top 10 Florida cities where the condo market is crashing hard in 2025. Stay with us until we expose the #1 spot. If you demand more unfiltered housing truth like this, hit subscribe now and let's dive in. Number 10. Sarasota. Once the iridescent gem of Florida's Gulf Coast, Sarasota marketed the perfect image: white sand beaches, a vibrant art scene, and luxury towers dominating the bay. But today, that picture is fractured. Condos that commanded $600,000 in 2022 now cannot sell for $420,000, a staggering 30% collapse. Inventory is spiked over 65% year over year, drowning the market with listings as desperate sellers slash prices to survive. The real disaster: ownership costs. Insurance premiums that were once $3,000 now exceed $9,000. HOAs and reserve mandates force monthly ownership costs above $1,200 before the mortgage is even factored. Buyers are paralyzed by the threat of surprise assessments: $20,000, $30,000, sometimes $50,000 per unit. Retirees on fixed incomes will not sustain this burden. Even investors are actively withdrawing. Rental yields that once reached 7% have plummeted under 3%. Sarasota's boom years are over, and the downturn is accelerating. What's exacerbating the situation is market conviction. Realtors who previously closed multiple units monthly now endure weeks without showings. Developers are secretly deploying steep discounts just to move inventory that once sold out pre-construction. Downtown's luxury projects have transitioned from status symbols into textbook examples of hyper-overvaluation. Simultaneously, local banks are aggressively tightening lending criteria, demanding massive down payments or outright refusing loans on older buildings. At open houses, out-of-state investors are doing something unthinkable just 2 years ago: walking away mid-tour, declaring, "We will wait another year." Sarasota is not just cooling, it is violently recalibrating to reality. That reality is a direct warning for every coastal Florida market that mistakenly believed prices could only ascend. Number 9. Bradenton. Just north of Sarasota, Bradenton's condo market is in full-scale retreat. Prices have crashed from nearly $400,000 to under $280,000, another 30% dive. Inventory is up 70% as 1,500 listings choke the MLS. The cause? Oversupply colliding head-on with affordability. HOA dues now demand $500 to $900 a month. Insurance bills that were once $2,800 annually now surpass $7,000. Add a 7% mortgage rate, and monthly costs hit $2,200 or $2,400 or more. Renting is the only logical choice over owning. Investors are fleeing. Airbnb profits have collapsed as occupancy drops below 55%. Nightly rates are down 20%, and pre-construction buyers are abandoning deposits rather than closing on inflated units. Bradenton's narrative is a brutal demonstration. When carrying costs explode, confidence simultaneously implodes. But the crisis runs deeper. The city once thrived as a retirement magnet, full of buyers relocating from colder states. Now that pipeline is bone dry. Retirees conducting basic due diligence are discovering they can rent a similar property in North Carolina or Tennessee for half the monthly expense. Many units now remain vacant for months as flippers who anticipated rapid turnover find themselves forced to cover inflated HOA dues on empty condos. Local agents describe a listing jam, everyone attempting to sell before prices plunge further. Developers who broke ground in 2021 face dire math, construction loans at higher rates, unsold inventory, and vanishing demand. Even longtime residents confirm it feels like a 2008 rerun, except this time the crash isn't driven by reckless lending. It is cost of living inflation meticulously consuming the dream from the inside. Number 8. Ocala. Ocala, the quiet inland city known for horse farms, was never forecasted as a crash site, yet it is firmly established as one now. Prices that peaked around $220,000 have tumbled to $160,000, a 27% free fall. Inventory has spiked 62%, and buyers have dissipated. Mortgage rates near 7% mean even a modest condo demands over $1,300 a month before utilities. For households earning under $60,000, ownership has become financially impossible. Worse, those presumed low-risk inland buildings are being battered by the same hurricane of expenses, new reserve laws, mandates, and insurance that skyrocketed from $1,800 to $5,000 a year. Special assessments of $10,000, $20,000, sometimes $50,000 per unit are decimating locals who cannot absorb these surprises. Investors who expected steady rental cash flow now watch their assets hemorrhage money. Ocala's crash is quiet but thoroughly devastating. The human toll is unbearable. Many small business owners who used their pandemic savings to acquire their first investment unit now fail to rent them enough to break even. Retirees who downsized from the coasts to save money are now realizing that inland safety does not equate to financial safety. HOA boards, often staffed by volunteers, are under siege, juggling furious owners, maintenance deadlines, and escalating bills. Some condo complexes have already witnessed multiple owners abandon their units, leaving associations scrambling to cover shared costs. Realtors confirm it is a buyer market again, but exclusively for those with substantial cash reserves. As one agent stated, "We have transitioned from bidding wars to absolute silence." Ocala was supposed to be the accessible Florida dream. Instead, it proves the cost crisis does not require an ocean view to drown a market. Number 7. Orlando. The land of Disney dreams is now experiencing a condo nightmare. During the pandemic frenzy, prices soared near $310,000. Today, they languish around $230,000, a 25% drop. Listings have nearly doubled, with 3,500 condos stagnating unsold. HOA fees range from $600 to $1,000 a month, and insurance costs have doubled since 2021. This translates to a two-bedroom near downtown that once cost $1,800 a month, now demands over $2,600. Renting is the only logical choice over owning. Investors are fleeing. Airbnb profits have collapsed as occupancy drops below 55%. Nightly rates are down 20%, and pre-construction buyers are abandoning deposits rather than closing on inflated units. Orlando's crash is particularly emblematic because it demolishes the fantasy that tourism guarantees immunity. The city built on dreams is discovering that when affordability shatters, even the happiest place on earth cannot escape the laws of economics. Number 6. Cape Coral. Cape Coral was the pandemic speculation champion, a waterfront paradise where values spiked 100% in 3 years. But today, that paradise is disintegrating. Median condo prices have plunged from $340,000 to $240,000, a 30% asset wipeout. Inventory is up 95%. Insurance for waterfront condos exploded from $3,500 in 2020 to surpass $10,000 now. HOAs are $600 to $900 a month, with special assessments of $20,000 to $30,000 required for flood protection. Retirees who once bought with cash cannot manage the carrying costs. Airbnb owners are generating losses. Occupancy is barely 55%, and nightly rates are down 20%. And pre-construction buyers are abandoning deposits rather than closing on inflated units. Cape Coral's fantasy of unending growth is extinguished. What remains is a cautionary tale of over-leverage and insurance shock. But the speed of the mood reversal is truly astonishing. During the boom, waterfront listings vanished instantly. Cash buyers lined up submitting offers tens of thousands over asking. Today, those same canals are defined by stagnant for sale signs. Realtors describe showing the same property repeatedly without securing any offers. Developers once building at breakneck speed now face half-finished projects and diminishing demand. The local economy is feeling the systemic impact. Contractors, insurance adjusters, and property managers report slowing business. Insurance firms have retreated from high-risk zones entirely, forcing owners onto costly state-backed policies. What served as a paradise for early retirees has transformed into a warning signal about what happens when climate risk, cost inflation, and speculation converge. In Cape Coral, the tide has not merely receded.
Number 3. Tampa. Tampa's skyline once symbolized unstoppable growth. That era is over. Median condo prices have plunged from $310,000 to $230,000, a 25% decline. Bayshore high-rises that sold for $600,000 now struggle to reach $400,000. Inventory has skyrocketed by 85% to 4,000 active listings, the highest level since the Great Recession. HOA fees, once at $450, now demand $1,000. Insurance near the Bay tripled to $9,500 a year. Monthly ownership easily exceeds $2,400, unaffordable for a city with a $70,000 median income. Short-term rentals are collapsing. Airbnb occupancy fell below 50%. Rates are down 20%, and nearly 40% of listings signal price cuts. Even Tampa's strong job growth cannot counteract structural costs. Developers are offering aggressive incentives, but confidence is shattered. And when confidence fails, prices inevitably follow. Tampa's story transcends mere numbers. It is psychological. During the pandemic, the city became a migration hotspot for remote workers, cash investors, and corporations fleeing higher tax states. Everyone believed Tampa had achieved permanent momentum. Now, that optimism has mutated into anxiety. Construction cranes that once dominated the skyline are slowing down. Buyers who rushed in for affordable luxury are realizing the term no longer exists. The real danger is not a lack of demand, it is a total lack of affordability. When an average buyer cannot sustain a condo payment, the chain reaction spreads through every segment of the market. Developers are fighting back with closing credits, furniture packages, even one-year HOA coverage, desperate tactics to keep projects moving. But incentives cannot repair market sentiment. Flood zone reclassifications, tougher inspection rules, and tighter insurance underwriting have made ownership feel dangerously risky. For a city that championed its resilience, Tampa faces its harshest truth yet. Resilience demands capital, and for thousands of owners, that capital is exhausted. Number 2. Aventura. Aventura, once Miami's glittering suburban refuge, is now a perfect case study in luxury meeting limits. Condo prices that peaked near $600,000 in 2022 have dropped to around $440,000, a sharp 27% decline that has stunned even high-end buyers. Inventory has surged nearly 80%, with waterfront towers and mid-rise units alike stagnating unsold for months. The pressure originates from costs, not just prices. Insurance premiums in coastal Broward and northern Miami-Dade have tripled since 2020, exceeding $12,000 a year for many buildings. HOA fees in luxury developments now surpass $1,200 a month, and new state-mandated reserve requirements are forcing additional special assessments, $25,000, $40,000, even $60,000 per unit in older towers. Aventura's skyline narrates the crisis. Gleaming glass towers overlooking Biscayne Bay, once marketed as low-risk luxury, are now financial minefields.
Buyers who once arrived from New York, Venezuela, or Brazil for secure investment properties are withdrawing as carrying costs overshadow rental returns. Even short-term investors who relied on seasonal Airbnb income have been severely hit. New city restrictions combined with softening demand have pushed occupancy below 50%, while nightly rates have fallen by nearly 20%. Developers who promised South Florida stability are secretly reducing prices, offering closing credits or covering HOA fees for a year just to move inventory. Realtors confirmed the confidence that defined Aventura's boom has vanished, replaced by deep hesitation and caution. Aventura's decline is critical because it was supposed to be protected, a community of wealth, waterfront lifestyle, and international demand. But no market is exempt from the math. When insurance doubles, assessments accumulate, and rental yields collapse, even luxury begins to fracture. The crash here is not overbuilding, it is terminal overconfidence. Aventura's shine has not fully dimmed, but its economic foundation has cracked, and 2025 may cement the moment when even the most affluent Florida markets finally faced reality. Number 1. Pensacola. Pensacola, the proud symbol of Florida's panhandle, has become ground zero in the state's condo collapse. Once extolled as an affordable coastal gem with military stability and small city charm, it is now reeling from one of the sharpest declines in Florida. Condo prices that peaked around $310,000 in 2022 have plunged to $215,000, a 31% crash that has annihilated years of equity and left hundreds underwater. Inventory has soared 90% year over year, saturating the market with listings that will not sell. Sellers slash prices by tens of thousands of dollars, but buyers have disappeared. Ownership costs have spiraled. HOA fees, once at $400, now reach $800, and insurance premiums, especially for waterfront units, have tripled to over $7,000 a year. Add 7% mortgage rates, and monthly costs exceed $2,200 in a city where the median income is $60,000. Investors have fled. Airbnb occupancy has dropped below 50%. Nightly rates have fallen by nearly 20%. Long-term rents cannot cover expenses. What was once a secure cash flow market now bleeds money. Developers struggle to sell projects as lenders withdraw support from older buildings that fail Florida's new reserve rules. Aging condos face special assessments of $20,000 to $40,000 per unit, forcing many owners to sell or abandon their investment. With lenders blacklisting entire complexes, only cash buyers remain, and they are aggressively bargain hunting. Pensacola's fall is especially devastating because it represented Florida's middle-class dream: affordable, stable, attainable. But that dream has shattered under the weight of insurance chaos, soaring fees, and investor flight. The sun still shines over Pensacola Bay, but beneath the calm surface lies a market in chaos, where even paradise is learning that nothing in Florida's housing boom lasts forever. Florida's condo market is not in correction, it is in reckoning. From Sarasota to Deltona, the core narrative is unified. Exploding insurance, aging buildings, stricter safety laws, and a tsunami of sellers chasing too few buyers. This is not a market cycle, it is a structural reset. The sunshine dream still shines, but the math, not the weather, now determines who can stay. You have been watching Discover the Nation. For more impactful breakdowns of America's shifting housing markets, subscribe now and stay tuned because this storm is still gaining momentum.